wisdomMakers presents The Psychology of Money by Morgan Housel, book summary. Welcome to wisdomMakers, where powerful ideas meet practical wisdom. Today's deep dive, The Psychology of Money by Morgan Housel, a timeless guide to how behavior shapes financial outcomes more than raw intelligence or complex models. Big idea. Financial success is less about IQ and more about behavior, patience, humility, emotional control, and long-term thinking drive outcomes far more than technical knowledge. Our unique life experiences shape how we perceive risk, reward, and money itself, which is why people can make vastly different choices that still feel rational to them. Core lessons. Behavior greater than intelligence. Good investing is a soft skill. How one behaves under uncertainty matters more than what one knows on paper. Housel contrasts a frugal janitor who quietly amassed millions with a highly educated financier who went bankrupt, underscoring the power of patience and restraint over pedigree and complexity. Luck and risk. Outcomes often hinge on luck and risk, which means we should avoid moralizing success or failure and instead focus on process, resilience, and humility. Markets are driven by a few extreme winners. Tails explain much of long-term returns, so missing outliers can distort our understanding of results. Compounding is confounding. Small, steady gains snowball into extraordinary results over time, while the urge to chase big short-term wins often backfires. Patience is a superpower. Saving consistently matters more than squeezing out maximal returns, because compounding amplifies behavior more than brilliance. Save more, want less. Wealth is driven by a high savings rate and a modest lifestyle more than a high income. The goal isn't to beat others, but to buy flexibility and options. True wealth is what you don't see, the money not spent, the freedom it quietly creates, and the control over one's time. Getting wealthy versus staying wealthy. Making money often requires risk-taking, keeping it requires paranoia, room for error, and a respect for uncertainty. Plan for surprises, build buffers, and be financially unbreakable, so temporary setbacks don't force permanent decisions. Reasonable beats rational. A financial plan that's reasonable and sustainable beats a hyper-optimized plan that ignores human emotion. The best strategy is the one that can be stuck with through volatility. Volatility is a fee, not a fine. Enduring it is the price of long-term returns. Pessimism's seduction. Pessimism sounds smarter because problems are immediate and vivid. Optimism is harder because progress compounds slowly and quietly. Guard against narratives that swing from euphoria to despair. Stories feel true in the moment but often miss the messy reality of uncertainty. Chapter highlights selected. No one's crazy. People act based on the personal history. What seems irrational to some may be entirely logical to others, shaped by different experiences. Never enough. Endless comparison erodes satisfaction. Define enough to avoid risk-taking that jeopardizes long-term stability. Tails, you win. A small set of outcomes drives most of the gains, positioned to stay in the game long enough to catch the outliers. Freedom. Money's greatest dividend is control over one's time, the essence of autonomy and a core ingredient of happiness. Man in the car paradox. People admire the car, not the driver. Status spending rarely buys the respect being sought. Room for error. Margin of safety, cash buffers, conservative assumptions, is the bridge between plans and reality. You and me. Different time horizons create seemingly contradictory but internally consistent decisions. Align strategies with personal goals and timelines. Practical takeaways. Prioritize a high savings rate and live below means to buy flexibility and reduce fragility. Automate investing, stay diversified, and let compounding do the heavy lifting over decades. Build buffers, emergency cash, conservative assumptions, and plans that survive bad luck. Avoid envy and comparison. Define enough and stick to a reasonable, durable plan. Treat volatility as the fee for long-term returns and avoid narrative-driven whiplash during market cycles. Closing thought. The psychology of money reframes money as a behavioral challenge. Master emotions, respect risk, embrace compounding, and seek time freedom over status signaling. In short, be consistently reasonable, not occasionally extraordinary. How emotions influence financial decisions. Emotions shape financial behavior by steering attention, risk perception, and time horizons, often overriding purely rational analysis and leading to predictable biases and market anomalies. Core emotional drivers. Fear and greed. Fear can trigger panic selling in downturns, while greed pushes excessive risk-taking in booms, causing investors to abandon long-term plans for short-term emotional relief or excitement. Overconfidence. Feeling overly certain about skill or forecasts leads to concentrated bets, excessive trading, and underestimation of downside risks, which can hurt long-run returns. Loss aversion. Losses feel more painful than equal-sized gains feel good, so investors hold losses too long, sell winners too quickly, or avoid beneficial risks altogether, consistent with prospect theory. Herding and FOMO. Following the crowd offers emotional comfort but amplifies bubbles and crashes. A small group of confident actors can sway the majority, reinforcing momentum and panic cycles. Regret and mental accounting. Fear of regret leads to inaction or doubling down on losing positions. Mental accounting makes people treat the same money differently depending on its source or bucket, distorting risk-taking and selling decisions. What the brain is doing. The amygdala. The amygdala rapidly encodes reward, punishment, and risk signals, triggering bodily arousal to financial gains and losses. Damage reduces aversion to monetary loss and alters trust and risk responses, underscoring its role in emotional financial choices. Common behavioral patterns in markets. Panic selling and overreaction. Heightened fear increases volatility and produces overshoots relative to fundamentals, a hallmark of emotionally driven markets. Chasing returns. Greed and overconfidence spur performance chasing and short-term speculation, often buying high and selling low as trends reverse. Status quo and disposition effects. Investors stick with defaults, hold losers hoping to get back to even, and prematurely sell winners to lock gains, driven by loss aversion and regret avoidance. Practical ways to reduce emotional bias. Pre-commitment and rules. Use written investment policies, preset rebalancing bands, and predefined buy-sell criteria to limit in-the-moment emotional overrides. Diversification and buffers. Broad diversification and appropriate cash reserves create psychological room for error, reducing the urgency to react to volatility. Process over predictions. Focus on an evidence-based process and appropriate risk for one's goals rather than short-term forecasts, headlines, or crowd behavior. Scheduled reviews, not reactive monitoring. Evaluate portfolios on a calendar, e.g., quarterly, versus reacting to daily price moves, which amplifies fear and overtrading. Awareness training. Learn to spot triggers, stress, euphoria, FOMO, and label the emotion before acting. Consider a cooling-off period for major financial choices. Professional guidance. Advisors can help identify biases, enforce discipline, and align portfolio risk with long-term objectives when emotions run high. Key takeaway. Emotions such as fear, greed, and overconfidence bias perception of risk and reward, while brain circuits like the amygdala hardwire swift responses to gains and losses. Recognizing these mechanisms and installing process-based guardrails helps investors stay aligned with long-term goals despite short-term emotional turbulence. Strategies to manage financial emotions. Managing financial emotions requires installing process-based guardrails that reduce in-the-moment impulses and keep decisions aligned with long-term goals. Build a rules-based framework. Write an investment policy statement, IPS, that defines goals, time horizon, asset allocation ranges, and clear buy-sell rules to pre-commit before emotions surge. Use predefined rebalancing bands or calendar checkpoints to realign to targets, so allocation decisions are triggered by rules rather than fear or euphoria. Be mindful that highly predictable rebalancing schedules can be front-run in large pools. Smaller investors should still prefer rules, but institutions may diversify timing or use thresholds to reduce predictability. Automate disciplined behavior. Automate contributions and investing to remove choice at emotionally charged moments and let compounding work regardless of headlines. Default to broadly diversified, low-cost vehicles to limit the urge to tinker and chase performance during market swings. Reduce trigger exposure. Review portfolios on a set cadence, e.g., quarterly, rather than reacting to daily price moves, which amplifies fear and overtrading. Create a cooling-off rule for major decisions, e.g., 24 to 72 hours, to allow the prefrontal cortex to re-engage when the amygdala is firing under stress. Right-size risk to your psychology. Align allocation with true risk tolerance so normal volatility does not feel like an emergency, lowering the odds of panic selling. Maintain adequate cash and emergency reserves to avoid forced selling, which reduces psychological pressure during drawdowns. Counter specific emotional biases. Loss aversion. Predefine exit rules and use lot-specific rules to avoid holding losers just to get back to even. Disposition effect. Overconfidence. Limit position sizes, cap turnover, and require disconfirming evidence before adding to a thesis to balance optimistic bias. Herding, FOMO, require a written, numbers-based rationale and alternative scenarios before any momentum-driven buy, reducing crowd influence. Process over prediction. Focus on an evidence-based process, diversification, periodic rebalancing, and cost control, rather than short-term forecasts or narratives that provoke fear or greed. Treat volatility as a known fee for long-term returns and judge decisions by process quality, not recent outcomes, to avoid emotional whiplash. Use accountability and professional support. Share the IPS and rebalancing plan with a trusted advisor or accountability partner who can help enforce discipline during turbulent markets. Advisors trained in behavioral finance can help identify biases, calibrate risk, and implement structures that minimize emotional overrides. Train emotional awareness. Learn to label emotions, fear, FOMO, regret, in real time. Naming the state reduces its control and supports more rational next steps. Recognize that acute stress recruits the amygdala and shifts choices toward fight or flight. Pausing decisions under stress improves outcomes. Practical checklist. IPS written and signed, quarterly review calendar set, rebalancing bands defined, e.g., plus or minus 5%. Automatic investments enabled. Emergency fund sized for 3 to 12 months expenses to prevent forced selling. Cooling off period for trades over a set threshold. Position size caps and turnover limits documented. These strategies replace emotion with structure, reducing costly behavioral mistakes and keeping financial choices aligned with long-term objectives despite market stressor. Key psychological biases that affect money habits. Core cognitive biases. Loss aversion. People feel losses about twice as strongly as equivalent gains, leading to holding losses too long, panic selling in downturns, and over-insuring or avoiding appropriate risks. Present bias, hyperbolic discounting. Immediate rewards are overweighted relative to future benefits, fueling procrastination on saving, underfunded retirements, and preference for high-cost credit over delayed purchases. Anchoring. Initial numbers, purchase price, prior peak, list price, unduly influence decisions, causing reluctance to sell below the anchor or overpay because of a starting reference point. Confirmation bias. Tendency to seek information that agrees with existing views, e.g., bullish on a stock, and dismiss disconfirming evidence, reinforcing poor choices. Overconfidence. Overestimating skill and underestimating risk drives excessive trading, concentrated bets, low diversification, and neglect of downside scenarios. Herding, FOMO. Following the crowd into hot trends and selling when others panic, often at exactly the wrong time for long-term results. Mental accounting. Treating money differently based on arbitrary categories, tax refunds as fun money, low-interest savings maintained while carrying high-interest debt, reducing overall financial efficiency. Status quo bias and inertia. Avoiding change or sticking with default choices leads to under-optimized portfolios, unclaimed employer matches, and failure to refinance or switch to better products. Recency bias. Recent performance looms larger than long-term history, causing performance chasing, strategy hopping, and misjudging risk after calm or volatile periods. Sunk cost fallacy. Continuing to fund a losing purchase or investment because I've already put so much in, instead of evaluating only future costs and benefits. Availability bias. Vivid or recent stories, a friend's crypto winner, a market crash headline, dominate judgment, skewing risk perception and allocation. Endowment effect. Overvaluing what one already owns, house, stock, car, creating resistance to selling or rebalancing even when it's rational. Familiarity, home bias. Preferring local employers' stock, domestic markets, or known brands, which reduces diversification and can amplify idiosyncratic risk. Optimism bias. Believing bad outcomes are less likely for oneself fosters under-saving, under-insurance, and insufficient emergency buffers. Emotional drivers. Fear and greed. Fear accelerates selling at lows, greed fuels chasing winners and leverage, both amplify volatility in outcomes. Pride and regret. Desire to avoid admitting mistakes or realizing losses can delay corrective actions. Regret leads to paralysis after a bad outcome. Social comparison. Keeping up with others' lifestyles spurs overspending, leverage, and short-termism. How these biases show up in everyday money habits. Saving and spending. Present bias and emotional spending undermine budgets and emergency funds. Mental accounting separates fun money from debt payoff, slowing wealth building. Status quo bias delays automating savings or increasing contributions. Investing. Overconfidence and herding drive concentrated, momentum-chasing portfolios. Loss aversion, anchoring, and sunk costs keep losers too long and winners too short. Recency bias prompts strategy switching after short bursts of performance. Debt and insurance. Present bias encourages high-cost borrowing. Optimism bias underestimates the need for coverage or buffers. Practical countermeasures. Pre-commitment and automation. Automate saving, investing, and bill pay. Use default increases, e.g., annual contribution step-ups, to counter inertia and present bias. Rules and checklists. Define rebalancing bands, max position sizes, and sell disciplines in advance to mitigate overconfidence, anchoring, and sunk costs. Friction and cooling off periods. Add steps or waiting periods for large purchases or trades to reduce emotional and availability-driven decisions. Diversification and simplicity. Broad, low-cost diversification reduces overconfidence harm and herding risk while easing adherence. Reframe and consolidate. View money holistically to avoid mental accounting. Evaluate decisions by forward-looking expected value, not past cost. Calibrate expectations. Base risk, return assumptions on long-run data. Journal decisions to expose confirmation and recency bias. Build buffers. Maintain emergency funds and margin of safety to reduce fear-driven errors and forced selling. Social hygiene. Limit exposure to hypey financial content. Align goals to personal values to reduce social comparison pressure. Advice and accountability. A neutral second set of eyes, planner or investment policy statement, helps flag biases and keep behavior consistent. These patterns are common, predictable, and manageable. Designing systems that make the right behaviors easy, and the wrong ones harder, does more for long-term outcomes than chasing perfect information or timing. Overconfidence bias in financial decisions. What it is. Overconfidence bias is the tendency to overestimate knowledge, skill, and the precision of one's judgments, leading to underestimation of risks and overestimation of expected returns. How it shows up with money. Excessive trading. Belief in superior stock picking or timing skills drives frequent trades, raising costs and taxes while often lowering net returns. Under diversification. Concentrated bets, single stocks, employer stock, narrow sectors, stem from conviction that one knows these assets well, increasing idiosyncratic risk. Risk underestimation. Overly narrow confidence intervals, optimistic scenarios, and dismissal of tail risks lead to leverage, option speculation, and insufficient safety margins. Confirmation and hindsight loops. Selective attention to supporting evidence and reinterpreting outcomes as obvious in retrospect, reinforce misplaced confidence and entrench bad habits. Illusion of control and knowledge. Mistaking more data, dashboards, or complex models for better decisions, confusing activity with edge. Performance chasing and hot hand beliefs. Short streaks of success are attributed to skill, prompting bigger, riskier positions and strategy drift. Planning and protection gaps. Overconfidence in stability of income, markets, or health leads to undersaving, thin emergency funds, and inadequate insurance. Common triggers. Recent wins or bull markets. Specialized familiarity, industry insiders, company employees. Social proof and media hype. Easy-to-use trading apps that gamify activity. Practical guardrails. Pre-commitment rules. Write an investment policy statement, IPS, with target allocation, rebalancing bands, max position sizes, and clear sell criteria. Require a cooling-off period, e.g., 24 to 72 hours, for large trades or allocation shifts. Calibrate with data. Keep a decision journal with thesis, probabilities, and alternative scenarios. Review quarterly to compare forecasts versus outcomes. Use base rates, anchor expectations to long-run asset class returns and drawdowns rather than recent performance. Automate discipline. Automate contributions and rebalancing. Use defaults and save more tomorrow increases to curb tinkering. Diversify and simplify. Prefer broad, low-cost index funds. Limit single position size, e.g., 5% minus 10% max, and cumulative, high conviction, sleeve. Add friction. Remove trading apps from the phone. Disable push alerts. Require a second check or red team review. For non-index bets, seek disconfirming evidence. Before entering a position, list what would prove the thesis wrong, the base case downside, and predefine an exit plan. Stress test and size for survival. Run, what if? S for recession, rate spikes, job loss, and 30% equity drawdowns. Size exposure so forced selling is unlikely. Get external feedback. Use an advisor, investment committee, or accountability partner to challenge assumptions and position sizing. Quick self-diagnosis prompts. Would I make this same trade if it was smaller, slower, or anonymous? What base rates support my expected return and drawdown? What new evidence would change my mind, and at what price? If this position went to zero, would my long-term plan still work? Am I increasing exposure because of recent wins? Bottom line, overconfidence is subtle and self-reinforcing, but it's manageable. Replace conviction-led decisions with process-led decisions, build structural safeguards, rules, automation, diversification, and continuously calibrate beliefs against data and base rates. How herd mentality influences markets. What herd mentality is? Herd mentality, or herding, is the tendency for investors to mimic the actions of a larger group, buying or selling because others are, rather than from independent analysis, which can drive prices away from fundamentals and increase volatility. This behavior is fueled by information cascades, social influence, uncertainty, and fear of missing out, FOMO. Where it shows up in markets. Asset bubbles and crashes. Collective buying on hype can inflate asset prices well beyond intrinsic value, while panic selling can trigger sharp declines, amplifying market swings. Momentum spirals and stop-loss cascades. Trend following by the crowd can reinforce price moves. When sentiment flips, automated stop-losses can accelerate sell-offs and reversals. Safe haven rushes. During uncertainty, investors herd into perceived safe assets, e.g., gold, pushing prices independently of fundamentals. Bank runs and liquidity crunches. Withdrawals spread by imitation and fear can become self-fulfilling, stressing institutions and markets even if fundamentals are initially sound. Why investors herd? Information cascades. People infer that others know something, so they follow observed actions rather than private signals, especially under uncertainty. Social proof and conformity pressure. Social cues and norms nudge alignment with the crowd, even when personal analysis disagrees. Emotional drivers, FOMO and fear. The desire to not miss gains in rallies and to avoid losses in downturns pushes synchronized behavior. Evidence and perspectives. Research and education sources describe herding as a bias that causes investors to copy others, often leading to inefficiencies, volatility, and suboptimal decisions. Policy and academic analyses link social influence and uncertainty to non-rational herding, explaining how collective mood can drive instability and bubbles beyond fundamentals. Practical implications for investors. Expect procyclicality. Herding tends to buy high in booms and sell low in busts, building plans that assume such cycles improves resilience. Manage exposure to crowd risk. Avoid crowded trades, diversify, and size positions with the awareness that rapid reversals are common when sentiment turns. Use process over sentiment. Rely on predefined rules, allocation targets, rebalancing bands, risk limits, rather than social cues and short-term price moves. Seek independent signals. Anchor decisions to fundamentals and base rates. Be skeptical of narratives driven by social media or group enthusiasm. Add friction and buffers. Cooling off periods for trades, reduce news, push alerts, and adequate liquidity can reduce susceptibility to cascades. Enforced errors. If you enjoyed this video, don't forget to like, subscribe, and share the wisdomMakers channel. Your support means a lot and helps us create even better content for you.